Analyzing and maximizing profitability with firm profitability reports. We're going to go right into the reports area, and I'm going to show you 3 different approaches to analyzing and maximizing profitability. We're going to look at 3 different reports. The first one we're going to look at is the profit and loss comparison accrual basis. All these reports are going to be on an accrual basis. Then we're going to look at the monthly profit and loss accrual basis, and finally the profit and loss accrual by project. Now, if you're looking at the write-up, and if you're watching this on YouTube, check the description for a link over to our blog so you can find the write-up. You can actually copy and paste the names of these reports as I've laid them out for you into the reporting area in Core so that you can get straight to those reports very quickly. So we're going to come down here to reports, and I'm going to do it myself. I'm going to take the first one, the profit and loss comparison accrual basis, and I'm copying it right off the write-up, and I'm going to press enter to search like it says, and here it is. And when you go to launch the report, it's very similar to how it works in, for example, BillQuick, right? So if you're familiar with BillQuick, you know the interface is different, but it works the same way. So you can establish your filters, but let's just go straight to run the report. I'll click continue. And the comparison is going to look at this year versus last year, year to date. And we're in the sample company, so there is no data for last year, but I just want to talk conceptually for a minute about what to look for here. Because what you'd be looking at is the dollar change and the percent change, and assuming there were numbers here, you know, it wouldn't be so astronomical as what you see here. But the idea here is you're looking for line items that varied significantly between this year and last year, and you want to understand why. You want to make sure it makes sense. If revenues were much higher this year, for example, compared with last year, that's good. That's what we expect and hope. We just want to make sure that that's realistic also, and that it's not based on a bookkeeping error, right? And then once we've assured ourselves that it is correct and accurate, then we want to understand why that happened. Looking down, cost of goods sold, if revenues went up by a certain percentage, cost of goods sold should go up, or down for that matter, by something in the range of the same percentage, right? Because cost of goods sold are generally, or should be, directly driven by revenues. So it stands to reason that if revenues went up 50%, cost of goods sold should go up 50%. And vice versa. So again, if you don't see something that that looks to be along those lines, then you want to take a deeper look and find out what's going on. You want to explain the anomalies and understand why they are what they are. Going down further, we look at the expenses again. If an expense is significantly off this year compared with last year, then we want to look into that and we want to understand why. Unless there's a significant difference that's expected because, again, revenues and or cost of goods sold varied significantly last year to this year. So that's how you're going to look at the comparison. The profit and loss comparison is you're comparing last year to this year based on the assumption that it should be about in line with what it was, and that's, there are certain trends that you would expect. So again, revenues went up, cost of goods sold go up, expenses might go up, but they're not so direct as cost of goods sold would be insofar as its relationship to income. Generally, in the bigger picture, the analysis we want to do on this, and as you'll see in each of the other 2 areas, is we want to look for where we did better than expected, and we want to understand why so we can exploit that. We want to do more of that. We want to identify what we did well and keep doing that or do more of it. And of course, on the other side, we want to identify where we've done poorly, where we didn't meet expectations, understand that so that we can start getting into how we might be able to correct issues along those lines. That's going to be the general description of the analysis that we're going to do, no matter which area, which way it is that we're looking at it. So the next report is going to be the monthly profit and loss accrual basis. Now here, instead of comparing this year to last year, we're really comparing month over month, right? And we're looking to analyze trends, and we're looking again for anomalies, and we're looking again to explain them. So in the write-up, I gave the example that when we're looking at something like this, we want to look at things like rent that we know should show up in the exact same amount every single month, month in and month out. And if we don't see that, and we see something like I explained in the write-up where we have it twice the amount in one month, and then the month before that it's missing, that just means we have a timing issue on payment, and that's easily corrected. I explain it in the write-up by simply entering bills each month and probably automating that so that the rent does show up on an accrual basis P&L in each month at the right amount. So that normalizes the data so that we can properly analyze what we really earned in revenue and what it really cost us to do business that month. If we have the rent doubled up one month and zero in another, then we're really skewing that picture. So it's important to have everything normalized. That's what that means. And as long as we have that in place and we look at this first with an eye towards making sure that that is the case, now we can look at trends. And once again, we want to see which months did we do really well in, and we want to understand why, and which months, where did we do poorly, and we want to understand why. And in both cases, we want to take away from that how we can do more of whatever it is that we did well. And then where we did poorly, we want to understand how we can identify and correct what the issues are that may have caused us to do poorly or just not to do as well as we would have hoped or expected to do. So that's your monthly profit and loss accrual basis. Last and certainly not least, we're going to look at the profit and loss accrual by project. So let's go here, and again we'll X out the search, paste that in, press enter, and there it is, the profit and loss accrual by project. Now here what we're doing is in the first two analyses we looked at firm-wide how we were doing, both by comparing last year to this year and then by comparing month over month for the current year. Here what we're doing is now we're looking at it project by project. The theory is that if I can manage each project individually and make sure that all my projects are as profitable as they can be, then the bigger picture will take care of itself. This, of course, as I mentioned in the write-up, assumes that overhead is not out of control, but as I also explain in the write-up, if overhead is out of control, that should get flushed out by one of the prior two analyses that we did. So here we're looking at things by project, and now at the project level, what we're looking for are the projects that did poorly. So once again, we can understand and identify why they did poorly and what could be done to improve them, how we might do better on the next project. And on the other side, we want to identify the projects that did really well, and we want to understand what we did to make those projects so successful. Were they run better? Were we more efficient? Was our project manager more on top of how the employees on that project were using their time? There's lots of things we can go into, lots of directions we can go in as we're analyzing this and digging deeper. But that's the whole point here at this stage. When we're analyzing the profit and loss accrual by project, we're trying to dig deeper, beneath the surface, which is what the other two reports really covered, to identify what's in the trenches and how we did and how we could do better and how we could improve where we've done worse. That, my friends, is how you can analyze and maximize profitability with firm profitability reports. Run these analyses, and the key here, and this was also mentioned in the write-up, the key here is the frequency with which you do this. Do this once and it might be insightful, but in the bigger picture it's useless. Do this on a regular basis, at least monthly, I would say. Then you start to get a better and better eye for when things don't look right. And of course, you'll catch things more quickly so that when there are problems that need to be addressed, you'll find and catch and correct them before they become major cash flow holes, as I like to call them, which can happen if we have overhead going out of control or expenses or anything for that matter going out of control. So do it regularly, do it at least monthly, and you'll find, catch, and correct things way before they become major issues. As always, I hope you learned something here and had some fun along the way. I hope you're having an absolutely fantastic day, and I look forward to seeing you on the web.